Hello, I'm Bernhard Schwetzler, and this is part 3 of our tutorial in terminal value calculation in corporate valuation. In this part number 3, I would like to show some pitfalls and caveats of the two models that we have discussed in part 1 and part 2, that is the Gordon-Shapiro model and the value driver model. So here is, as a wrap-up, again, our valuation equation coming from our value driver model. That is, we simply use this triangle here that growth can be combined out of retention rate and RONIC, and simply plug this into our valuation formula. Here we solve for the retention rate and plug it in, and here we plug in the growth rate as a combination. So this formula, as we have seen in the section number 2, offers some nice sanity checks that helps to prevent, let's say, the major or serious mistakes and flaws in corporate valuation reports. Yeah? But also there are some drawbacks that we may end up analyzing and detecting based on these models here. Yeah? And some of the drawbacks come from the mindless use of sensitivity tables that you may know from your day-to-day practice in business. That is, you have an Excel sheet and you want to know how sensitive the value of the corporation is with respect to changing conditions in the cost of capital, in the WACC, and in the growth rate. And starting from a base case, you simply run your Excel sheet and stepwise change the WACC and the growth rates. Based on this model, I would like to show you now that it's quite dangerous to do this, at least to do this mindless, without adjusting your retention rate. And the idea behind that can be best explained in an example. Yeah? So our example starts, the first year's no-plat is 150,000. We have a retention rate of 30%. That means 45 is retained and 105 is cashed out as free cash flow to debt and equity holders. We have a WACC of 12% and we have a growth rate of 4%. That is, our base case terminal value is 1,312. Yeah, so if we go here, then this is the value of our base case. And now you see here our sensitivity table. We change the growth rate from 4 up to 6 or down to 0, and we change the WACC from 12 here down to 10 and up to 15. And these are the values that we get. Yeah? But this is very dangerous because if we do this mindlessly, we may end up in having at least some of the values resting on flawed assumptions. So let's look at this case here. Yeah? So if we change our valuation formula to a growth rate of 0% and stay at the 12% here, then obviously the value is 105 here divided by 12% is 875. This combination here is obviously not very reasonable. Why? It does not take into account that if we reduce our growth rate from 4% down to 0%, obviously that means that we still retain here 30% of our earnings. From 150, 45 are still retained to get the same free cash flow, and that these 45 here are not creating any growth. Yeah? And you see that this obviously is something that is not very reasonable, because that would mean that every year we would set aside a significant amount of money to acquire new assets, and the new assets would not create any return and any additional growth in earnings. Yeah? So this is obviously not very reasonable. So if we walk down here into this direction and decrease the growth rate, obviously from a certain point on, we need to adjust the retention rate as well. Yeah? And here for the growth rate of 0%, obviously a reasonable assumption for the retention rate in this setting is that we also retain 0%. Yeah? So if our earnings do not grow, then it's reasonable to assume that our assets should also not grow, and that means that we should not retain anything and we should not buy any new assets. And if we now recalculate our value at the retention rate of 0, that would mean that we cash out the entire 150, then we would get a value of 1,250 being reasonable compared to the flawed one here of 875. Yeah? So if we walk down here, obviously in big steps, we would have to adjust the retention rate as well. The other thing is, another example here, the implied RONIC for our base case is 4% is the growth rate, 30% is the retention rate, so our implied rate of return is 13.3%, and it's wise to fix this figure or to calculate it in any of your valuation or your own valuation reports, because if we walk down here, up and down here, obviously changing the WACC at the constant RONIC here would imply that we change the spread as well. So if we walk down here, for instance, from 12 to 14% and leave the retention rate constant, obviously that would yield the result that we set aside money, buy new assets that yield a rate of return of 13.3%, whereas at the same time our WACC has increased up to 14%, and that means that at this step, obviously, we would start to burn money because the rate of return of 13.3% is lower than our WACC of 14%. So if we step down here, it will also be reasonable that as we don't earn our cost of capital anymore with our rate of return, if it is supposed to stay stable, we will obviously also stop to reinvest and to retain, and that means if we stick to then a reasonable retention rate of 0%, that would imply a cash out, a free cash flow being equal to the note plat of 150 divided by 14%, we would get a value of 1,071 instead of a value of 1,050. You see in the second case here, our deviation from the correct value is obviously not that big, but in this case, you see that the model is really flawed and we have a significant valuation error in here. So what can we infer from this? First, that sensitivity tables with big steps with respect to the growth rate here, absolute percentage point-wise, and with the WACC here, are dangerous. That is, one solution would be that we restrict our attention to smaller steps around our base case, because within these smaller steps, we may stick to the same and constant retention rate. If we really want to make bigger steps, then obviously we can no longer work with a constant retention rate of 30%. Then, of course, our table will have to be adjusted that for these steps downwards, we will have to adjust the retention rate as well. So it's again then no longer this simple Excel sensitivity table. Okay, so that is simply, yes, a warning. Being careful or be careful when using these sensitivity tables. As I said, the spread, that is the difference between the rate of return, ROIC, on our invested capital, and the WACC is crucial for determining the impact of growth on the terminal value. I would now like to show two caveats that may at least decrease the significance of our findings, or some pitfalls that you should avoid when using these formulas. Yeah? The first caveat is obviously we are currently comparing ROIC and WACC, and from our Finance 101 class we know that we should, instead of comparing ROIC against the WACC, we should always use and compare the IRR, the internal rate of return of our new project against the WACC. Yeah? So the problem with ROIC is that ROIC is a accounting-based return figure, and as such, it is, as any book value based figure, it is affected by depreciation, and that yields the result that our ROICs are not constant and not stable within one project. Here is a simple example. That is, we have an investment that carries an investment outlay of 900, and we have a straight line depreciation of 225 every year, and the cash flows of our projects look like this: 450, 350, 450, and 350. And you see here our straight line depreciation. You see here our earnings and profits figures based on our straight line depreciation, and here you see the decline of our book value. And if we now calculate our rate of return by always linking our profit to our book value in the preceding or end of the preceding period, then we get this. Let me just highlight this a bit better. Then we get this development of our ROIC. You see that our ROIC based on the book values is widely going up and down, from 25 down to 19, up to 50, and then to 56. As we have a WACC of 10%, this is in this particular example not that much of a problem, but still it may be that you have an investment opportunity that has a spread based on ROIC minus WACC that is negative in some years and that is positive in some years. Yeah? So that may create a problem in our case because, as I said, we just do this. We compare ROIC and WACC. One thing that I would like to note here is that there is a theoretical depreciation that yields the result, A, that the rate of return is constant every year, and B, yields the result that the rate of return is equal to the IRR every year. And there are two assumptions that are necessary for this depreciation. The first assumption is that it's a depreciation that is based on the change in present value from one period to the other, as you can see here. And the second assumption is that the present value of the still outstanding cash flows is calculated not by the WACC, but is calculated by using the IRR. So you see that if we use a discount rate of 28.67% on each and every year's outstanding cash flows, then we get this development here of our present values, and the change of the present values is then our depreciation. And if we calculate then our invested capital or our excess or our earnings figure, then you see we get our result that the rate of return based on these figures is equal to the IRR. So the answer to this problem is then, yes, there is a particular depreciation that yields the result that IRR is equal to ROIC. The second caveat that I would bring forward can be highlighted by looking at the base case in this table here. Our base case assumed that our WACC is 12% and our ROIC, implied ROIC, is 13.3%. So we have a small but still greater than zero excess rate of return. And in this situation, your client or yourself may have the idea, well, we earn a positive spread of 1.3%. Why not increasing our retention rate from 30 to 40% to harvest and to pocket in additional excess rate of returns and additional positive net present values? This argument is also very carefully to be analyzed, because the point that I want to make here is that the figures that we see in our calculation formula are the average rate of returns on all our newly acquired assets. And if we want to answer the question on whether it pays to retain a bit more money and buy a bit more of new assets, then we would need to know the marginal rate of return on the last unit, marginal unit of our invested capital. And here is a simple example that tries to highlight this argument, why it might be dangerous and flawed to use the average rate of return. Yeah? So we have an investment, a one-period model is this, very simple, that requires an investment of 100 and brings us one period from now a cash flow of 150, and that yields a rate of return of 50%, 150 over 100 minus 1. If we would scale up our investment for another 100 and increase it from 100 to 200, then we assume that the next 100 million bring us just a rate of return of 0. That is, we get just back the additional 100 here. Yeah? You see that we increase our investment by 100, and that just increases our cash flows also by another 100. And so the marginal rate of return on the second 100 is equal to 0. That is, we just get our money back. And obviously, at a WACC of 12%, obviously, if we are at that step here, having invested the first 100 million, we will obviously, when looking at the marginal rate of return, we will not invest another 100 because the marginal rate of return is 0, whereas the WACC is 12%. If we would base our assumption, however, on the average rate of return, that is 250, our total cash flow, over 200, which is our total investment, then our marginal rate of return would be still 25%. And if we would compare these 25% against the 12% WACC, obviously we even might find it worthwhile to think about another 100 million to be invested beyond the 200, despite the fact that we are already in the red area if we invest more than 100. Yeah? So the point is, our average rate of return is 25%, is greater than the WACC, whereas our marginal rate of return, if we are here at the 100, is 0% and is smaller than 12%, and that means we should, instead of packing another 100 investment into this investment opportunity, we should scale down investment back to 100. Yeah? So you see that this is let's say, a standard assumption in microeconomics when looking at investment opportunity sets, that if you scale up your investments, that obviously our rate of return is decreasing. Yeah, so the first units invested that have high rates of return, and then as you expand and scale up your investment opportunity, the rate of return becomes lower and lower. And now, as the average rate of return still contains the high rate of return of the early good investment opportunities, obviously it is higher than the marginal rate of return that is here, the ones that we would need to know in order to judge on whether we should invest 1 unit of money more. So, bearing this potential pitfall in mind, we still are able to identify flawed assumptions when comparing our average rate of return, our average ROIC against the WACC. Because if the average ROIC is smaller than the WACC, we still know that we are over the top with respect to our optimal investment scale. Yeah? Because we know that our marginal ROIC is even smaller than the average one, and that is, if the average one is already smaller than the WACC, then the marginal one definitely must be smaller than the WACC as well. Yeah? So still, without any further industry expertise, we would be able to identify the flawed assumption in the model if the average ROIC on the newly acquired assets is smaller than the WACC. But here, if the average ROIC is greater than the WACC, then obviously there is further industry expertise needed whether to judge the question whether we should invest another unit of money into our firm or not, because we would need to know, as we know our average ROIC is greater than our marginal ROIC, obviously it may well be the case that the average ROIC is greater than the WACC, whereas the marginal one is close or even smaller than the WACC already. And if we would want to judge this question and answer this question, then obviously further industry expertise is needed with respect to the shape of these investment opportunity lines. Yeah? So you see here the investment opportunity line 1 carries the same average rate of return than the investment opportunity line 2, yeah? But you see that obviously the slope, the marginal rate of return of the investment opportunity line 1 is already quite flat compared to the WACC. That means in the case number 1, obviously the marginal rate of return is lower than the WACC, and our optimal investment scale is already exceeded, whereas in the case number 2, obviously the slope of our investment opportunity line may well still be higher than the WACC, and that would mean that we could afford to invest another unit into our investment program carrying a positive net present value. So again, taking this caveat into consideration, it still allows to detect flawed valuation model if the average rate of return of our newly acquired assets is smaller than the WACC. But if the average ROIC of our newly acquired assets is greater than the WACC, then in order to judge on whether we should scale up or scale down our investment opportunities by increasing our retention, we would need further industry expertise. Thank you.